Thank you for joining today's webinar. Some preliminary housekeeping items. Questions can be submitted through the Q&A function. Today's PowerPoint presentation slides will be distributed after the webinar concludes. And if you are requesting CLA credit in New York, please listen at the end of our presentation for the validation code needed to obtain CLA credit. Now on to our presentation. Joining me today are my partners, Jenny Johnson-Ware and Tom Ward, who will discuss strategies for mitigating tax and compliance risks in family offices. With that, Jenny, what can family offices expect at the onset of an audit?
Thanks, Tim. So audit risks, and some of these are risks and some of them are foregone conclusions, like a drain on resources. An audit will divert time and attention of the professionals in the family office, likely at least some time and attention from the family members who are under audit, plus there will be professional fees. You've got tax exposure, not only US federal tax penalties and interest, but states and other taxing authorities, some of whom receive information automatically from the IRS. And there's actually much more coordination now among the international tax authorities than there ever has been at any point in history. So you can expect some automatic exchange of information to be happening in ways that it's really never happened before. Also, civil liability, and this can come up in any number of ways. There can be exposure through the securities laws. If the office is handling funds of a nonprofit, a private foundation, there could be an investigation by the state attorney general's office. There could be exposure to lawsuits by beneficiaries for breach of fiduciary duty. There could be issues related to banking relationships and potential bank fraud if misrepresentations have been made in the process of seeking loans. You can also have exposure through the audit process of sensitive, confidential information that might be harmful to the family or the office in a variety of ways. And we often have to be very sensitive to this kind of exposure and risk because it impacts people's relationships with others that they care about, their reputation among their peers and their colleagues. And so whenever we're preparing for an audit or looking to mitigate the risks of an audit, we think very hard about what kind of information could come out and how could it hurt someone in ways that have nothing to do with tax. So when you think about all of these different things that can happen when one of our families is under audit, it makes it well worth the effort to do everything we can to mitigate those risks ahead of time. And that's why we've put this presentation together today so that we can walk you through some proactive things that you can do to make sure that these things don't happen. We'll start with Tom talking about some internal controls and procedures.
Thank you, Jenny, and thanks to everyone for joining us today. Hopefully everyone survived 9/15 and is gearing up for the end of the month and October 15th, always a fun time of year. But picking up on Jenny's point, where does this start? Where do we start thinking about how to best think through policies and procedures? Well, it really starts at the planning stage. In other words, as we think through how to best service our family members and come to them with strategies and suggestions and structures, I'm sorry, I may have missed a poll question. So
that was me. I should have announced the poll question.
No worries. Go ahead, Jenny.
So have you participated in an IRS audit as either a taxpayer or an advisor? And if so, how long did it last? And we're just curious about the experiences of the people on this call. We do have several polls plugged in at different times. And this is more just to gauge what people have dealt with who are on this call and share that experience with others. Okay, the yes over a year fits with my experience. I've done lots and lots of audits that last more than a year. So this is helpful to see. Thank you. And back to you, Tom.
Yep, thank you. So so as we're thinking through the planning opportunities for our families, what are the that's where we can really start with some of these controls and procedures. So document creation and execution. What are the documents we want to have in our files to be ready to discuss our thinking with our friends in DC or at the state level? This would be where we would have to decide for planning opportunities, what is it that the family office wants to have? Does it want to have a memo? Does it want to have an opinion from counsel? What is for the requisite, for the transaction under consideration, what makes the most sense? When are you going to bring in outside service providers? Now, of course, not every time you're working for the family do you need the help of outside assistance, but if it's a transaction where you would expect to rely on outside service providers, when do you bring them in to the process, because they can help think through the creation and execution exercise? And something that I always emphasize when I work with family offices, it should be a holistic team approach. And so, we should also think about, when do you involve, if you're going to use external accountants, when should they be brought into the process? And I think it always is beneficial to the family if the service team is sort of brought in at the right stage and hopefully before filing day to help to confirm and provide a holistic assessment of the transaction, its risks, and its benefits to the family. And then thinking through the documents. Is it a memo? Is it opinion? What do we need? And then moving from that to actively managing your document retention and your information requests. And on this point, I want to underscore the word actively. It's human nature, at least for me, to put something in a file and forget about it, or to save everything. And so I think it's a helpful exercise to set some time frames in which you go through your files. Are there drafts that don't make sense anymore? Obviously not in the course of an IRS audit, you wouldn't be doing this, but a regular routine review of your files, emails, and the such to make sure that you're keeping what you need to keep, but not necessarily keeping everything that was ever said about the potential transaction. And when someone asks for information about a particular transaction or a particular position, thinking through the protocols for how you provide that information. Who should get it? What are the considerations? Jenny's going to talk to us about attorney-client privilege and some other things, but it's just being mindful and having a process in place so there's some consistency and expectation upon the employees about what's appropriate to share, and if a particular types of requests come in, who should get it. And then, very, very important is confidentiality in security process and procedures. Certainly, as we talk about tax return information and the such, we all can appreciate the sensitivities that go into those returns and the protections we'd like to try and maximize. But sometimes it doesn't have to be what's in the tax return. It can be something as simple as addresses of family members or social security numbers of family members, the types of things that we probably are diligent about for our own families. Just thinking through, what is the process? Are you going to use passwords? We recommend that you have some type of confidentiality agreements with your employees, because even the most trusted employee could decide to part ways from the family office. And again, it's always nice to have a clear understanding when that happens as to what the responsibilities and expectations are in terms of things learned while working for the family office. Again, I mentioned personal information, passwords. I get the opportunity to work with a lot of family offices, and more oftentimes than not, there are passwords, and while they can sometimes be a pain to try and remember what they are, they serve an invaluable purpose because, of course, they avoid sort of the inadvertent disclosure, or what I'll call a trap for the unwary, but maybe it's just me, and it's the dreaded autofill in emails. I can't tell you the number of times I've drafted an email, and in an attempt to be helpful, my computer starts to populate who's receiving it. And there have been a few instances where I've sent emails to internal McDermott lawyers who aren't here anymore. They're at clients now, but because the autofill just assumed they were. So again, it's just, some of this is sort of basic, but it's just sort of helpful advice, because I have seen instances where information has inadvertently gone to wrong recipients, and having that password protection, can be, a lifesaver in that instance. Jenny, do you want to talk a little bit about the proactive steps one might take here?
Sure. So this will be a little bit different, where the internal controls and procedures are things that are part of the day in, day out handling of the office. The kind of proactive analysis I'm going to walk you through at the end of this session is more of an effort and a process that you go through when you want to wrap your arms around all of the risk and exposure that the family or the office could have at hand. And it comes in handy at transition times if you've got a new fiduciary stepping in, or on the, a death of a patriarch or a matriarch and a handing of the reins to the next generation, or a hiring of a new CEO. Or just at a moment in time when you realize, maybe we've been taking more aggressive positions than we should have, and I'd like to understand what they are and what we can do about them. This is the kind of go in and do a thorough analysis and a vetting of where your risks are, and then you start taking the proactive steps to mitigate those risks, both to hopefully prevent an audit from happening in the first place, and if it does, cultivate everything you need to have the best chance of a successful result at the end of that audit. So we'll loop back to a whole process for how you do that at the end of this session.
So drilling down on some of the internal controls and procedures and documentation point, review corporate governance of family entities and the roles of the various family members as owners, directors, and officers. This is sort of one of those that is very easy to assume. Well, it's family controlled, and A has always been the president, or B and C have always been the vice president. So for this particular instance, it must be true that they can do this. And I appreciate that instinct, particularly with families, because inevitably it does seem to be the same control group involved. But particularly when you get into the niceties of trusts and private trust companies and trying to delineate each person's role and responsibilities for a particular document, I think this is an invaluable exercise to just always have a procedure set in place where, niceties such like corporate resolutions to, always reaffirm who the board and officers are. Again, appreciating that in a family context, those may be the same individuals for a long period of time. But it's a good exercise, I think, to do, and a good corporate governance task to just always kind of go through and update those books and records and try and have them as current as possible, so that when someone is asked to sign something, or we can determine quickly what capacity they have. First, can they sign for that particular subsidiary, and what role and authority do they have at that subsidiary, so that we can ensure that there's no foot fault in terms of execution. Another example, again, coming off of 915 and all the filings, all the pass-through filings that had to be made. Who can sign partnership returns? The tax law requires that it has to be a tax partner. But again, as a technical matter, it can become the case where a practice forms where the same person signs, and perhaps they're not a tax partner. So again, just reviewing your signatory processes for your tax information. Again, you have your state tax returns for those that weren't due on September 15th, having those in place. Partnership representative, that's a new audit concept for tax partnerships. Those don't have to be tax partners, but you want to have a clear understanding of who your taxpayer representative is. Again, within the family context, there can be a view that everyone's related and aligned, and it's not going to be a big deal. And 95% of the times that's probably true. But again, we want to develop best practices here, and so I think that kind of corporate review exercise and updating can be invaluable. I talked briefly about transaction documents and key areas of risk, and Jenny will talk to us a little bit later about how to quantify those. But again, if you're engaging in a transaction, again, oftentimes with affiliates, there can be a natural inclination to perhaps not, do all the documents, because there's an understanding that, of course, I've always provided services to this type of entity, and they always have paid me this type of fee. But again, I think it's, making sure that you have those papers to support those positions, is important if you're asked to talk about that with the IRS or a state taxing authority. And obviously highlighting those areas of risk and understanding what your arguments are and your support and your file is. And then just having a clear view as a family office, of course, you can be asked to provide a lot of services to people. And so I think you want to have a clear understanding about what it is that you are providing to the family, who your clients are, and having service agreements between those clients and the family office, not just for tax. The world doesn't always revolve around tax, of course, but having a clear understanding as to what your roles and responsibilities are, so that as resources are being directed toward those services, there's an understanding about what it is you're providing and what you're not providing, and so there's no confusion or misunderstanding on the part of everybody. And then, for some of you, or maybe many of you on the call today, you may have very complicated family office structures that are dealing not only with family members, investment partnerships, but also perhaps with operating businesses that the family still control and run. And so there can be a lot of interconnected lines running back and forth between what the family office is doing and its relationship to all of those different end users, and that can become pretty complex and might require a detailed set of policies and procedures to sort of provide a blueprint. And I think it's always good practice to consider having a third party take a look at that on a periodic basis and just give you sort of a checkup. Hey, this, in the last couple of years, we've seen this sort of develop as a new technique family offices have been using to address this type of policy, this type of procedure. And going through that self-audit exercise every couple of years, I think, can be a very valuable exercise. Again, just to see where improvements can be made and things like that. So turning to the next slide, please. So what are some specific areas that family offices are faced with where documentation can be, very, very important? And again, this isn't just documentation when an audit starts. This is when we're putting a structure in place. So if our family office is taking the position that it's engaged in a trade or business for tax purposes and therefore has the ability to deduct expenses above the line as 162, it's very important to have the documentation in place to substantiate those conclusions. So we want to have our service agreements in with the employee, with the end users of our family office. We want to have, not every family office has employment agreements with their employees, but some do. So you want to have those in place, or confidentiality agreements. If you're providing your services not for a fee, but for a profits interest, you want to have a clear understanding of what the profits interest calculation is in your partnership agreements to whom you're providing your services. And you want to, memorialize that and have those relationships documented, close in time to the implementation date. You don't want to find yourself trying to, we've always had a course of conduct, but we haven't reduced it to paper yet, and now we're being asked to show the paper. Let's prepare it now. Not to say that life doesn't happen and that couldn't happen, but I think we want to, at the upfront, establish these documentations as quickly as possible. In terms of material participation, Jenny, I know you've had some thoughts on that.
I do. So I see material participation issues come up probably more frequently than any other issue when a family member is claiming losses that occurred in a trade or business. And especially with this economy and this market and certain businesses not doing well these days, I think this is going to be an issue we're going to see a lot over the next few years as returns from this tax year get audited, because there will be some losses that people are trying to claim, and they're going to have to evidence material participation. And this is where, on the back end, as the person who's trying to prove to the IRS that material participation happened, I always find myself wishing someone had been paying attention a little bit better on the front end and creating contemporaneous records to help me out. For example, I had to try a case and prove material participation of a taxpayer who didn't use email, didn't keep a calendar, didn't create any documents on behalf of the company, and where the CEO of the company testified that he didn't actually have anything to do with the business. Talk about an uphill battle that I end up having to deal with on the litigation side. And we won. By some sheer miracle, we actually were able to prove that he did more than 500 hours of work in that business. But my job could have been a whole lot easier if anybody had been keeping contemporaneous records of what he did, when he did it, and how long it took him. So I can't encourage you enough to figure out a system that works. It doesn't have to be like we lawyers do, where we have to write down our time in quarter hours every single day. There can be an administrative assistant or employee who helps do this on a weekly or monthly basis. But it's really important to capture what was done and how long it took at the time it's happening, so that we can defend this and put the issue to rest quickly in an audit instead of having it drag all the way through a long trial.
Jenny. The next one, again, a classic situation is the interfamily loans. It maybe happens almost daily, for some families. Again, obviously we all keep very good books and records, and we have our spreadsheets and our notes that establish, I'm loaning $100 to this entity, and I'm going to use the AFR, and I'll get around to documenting that. And of course, it's not an intentional disregard, but other things happen, and maybe that documentation doesn't get done. But again, that's the type of instance where in an exam, trying to support a loan characterization, you can expect that we're going to be asked to see those loan documents. And so we're documenting those loans, and then kind of going back to that actively manage our documents. Again, sometimes, if it was intended to be a 3-year note, and guess what? It's been 3.5 years, and you go back now and realize that the note hasn't been paid off yet, and you need to refinance it. Again, not the end of the world, of course, but things that can be done. So again, the more documentation we can have, and the more it's consistent with what everyone's economic expectations were, the better it can be, where we can support those conclusions in front of a reviewing body. Because not only can we say we meant it to be a loan, we can show our contemporaneous documentation supporting loan. Very, very important practice.
Next one is obtaining written advice for potential tax risks and issues. And I want to make it clear that it's a wonderful idea, and a good, well-constructed opinion based on actual facts can be very effective penalty protection. A flawed opinion that makes factual assumptions that are just not true is going to be disastrous, because if you produce it, there's going to be privilege waiver on the entire subject matter of that opinion. And so if the taxpayer or the office has gone opinion shopping, and they've had 2 other people tell them, ooh, no, sorry, that doesn't work, and then get an opinion from someone else by not fully quite disclosing all of the facts, you can bet that all of those opinions and all of those communications about that factual issue will come in if you try to rely on that opinion. So this is an area where you have to be very, very careful to make sure you're getting good advice, and that the advice is based on all of the actual real facts. And then our last one is reviewing document retention policies, so only necessary documents are retained. And one example I think helps put this issue in context for people is, sometimes the transactions that we're planning for family offices are very complex, and the tax result depends on the minutia of how the transaction is structured. And sometimes, if you're in a position where you're explaining to an elderly individual who has no real knowledge of tax how this transaction is going to work, there's a temptation to simplify it and create a diagram or a summary that simplifies and glosses over parts of the transaction that are essential to the tax treatment. And if those documents exist, A, and B, are in the files by the time I have to litigate and defend your tax position, it's going to make my job a lot harder. So if those documents have to exist in the first place, and I would prefer that they didn't, but if they do, I would like there to be document retention policies in place that maintain the final deal documents, and a policy that lists for each transaction, we are going to retain this list of items, and not other imprecise summaries or other diagrams. So that's my thought on saving only the documents that really are necessary to be retained. And I'll hand it back to you, Tom.
I think we might have a poll question here. on
I
internal
believe
controls
we
and procedures?
do.
So here, the question is, would you like to improve the internal controls and procedures in your family office or in one or more of the family offices you advise? No, we're doing everything right. Yeah, there's a couple areas we could strengthen, or we could use a complete updating across the board. So if you could share your thoughts on that, we'd appreciate it. Okay, so 71%, it seems like they're doing a very good job, and there's a couple areas they could support, and then a significant minority that could use an updating across the board. And then 7% who are got it all in place. That's awesome. Okay. So going to slide 7 now. So taking some of these concepts and thinking about specific instances where documentation and policies and procedures can be helpful. And this is not obviously an exclusive list, but just some areas that we see come up more than once. It's not unusual for the families we serve to have foundations, given the charitable intent often of these families, and making sure that the relationship between the family office and the foundation takes into account some of the special tax rules that address self-dealing and related issues. So we're probably all familiar with the basic principle that when you deal with foundations and have related parties in the foundation, there's a host of rules that police the activity of the foundation as it relates to the disqualified persons. And so, for example, a family office may provide investment-related advice to assets that are held by a foundation. It may choose not to charge anything. There is a regulatory example that allows for it to charge something, but it needs to be able to demonstrate that the charge is reasonable. And so, I've seen clients who, will do 482 type studies, transfer pricing studies, to come to a determination. Now, again, I don't think that is what has to be done in all instances. It's always what's your risk profile, but it's not unusual to see some sort of market comparables looked at to sort of come up with a sense, and then documenting your file so that if someone asks, why did you think $100 was the right amount to charge your foundation, you can pull out your file and say, here's the contemporaneous evidence that we looked at when we came up with that pricing. Another not uncommon situation is state tax residency. And given, tax law changes and other world events, the idea that family members are mobile and can work in a lot of different places, if we're trying to achieve a specific state tax residency for our client, and they might have multiple touch points with states, how do we support the conclusion that, I'm a resident of state A, even though I may have contacts with states B and C? Again, not only as an individuals, but of course trusts also are interested in the states to which they're deemed to be a resident. And again, well, I'm not a trust expert. Those rules, can sometimes be counterintuitive in terms of how a state decides what is relevant for purposes of establishing residency. And so steps that are being taken to try and change the residency of a trust. Again, the point here being, let's make sure that we've done the documentation and set up the strongest fact case so that if we have to turn it over to Jenny to defend it, she's starting with the strongest foot possible as to why we are now a resident of state A. A lot of families have the private aircrafts or private watercrafts that they use, oftentimes for business, but sometimes for personal use. And as those who've had to deal with these issues probably appreciate, the tax rules can be different depending on what the use is. So to the extent you're looking for more favorable depreciation and the ability to deduct expenses, you're going to want to support the conclusion that it's business use, whereas the occasional vacation trip is personal in nature. But again, like material participation, the better your contemporaneous records are, the easier it is to demonstrate if you're asked those questions. Jenny, I think in terms of the last one, you had some experience with the.
Yeah, I will jump in on that. And on the airplane issue, every client I have who owns a plane has been audited on that issue. It is so common for the IRS to dig in and want to look at those issues that is a place where we need to be extremely careful with record keeping. And on the last one with the valuable, tangible personal property, this is another place where it's hard to keep all of the records consistent with what you intend to do. So I've seen a lot of situations where a piece of art is gifted from a senior generation to a family limited partnership or to one of the children, whatever it may be. But the insurance stays on the main insurance that is maintained by the parent. And the location of the art listed in the insurance paperwork is still the parent's home. And then we have 2036 issues about whether it's actually moved out of the estate or whether the parent continued to have possession or enjoyment of the property. So these are all these areas where different documents, sometimes you don't think when you do a transaction or a gift, you don't say, okay, now we have to go to our insurance schedules. And ideally, we should be making the people who own this personal property pay for their own insurance, or if not, we need to have an agreement about why not, and we need to document that this is happening and it really is owned by this other entity, and that should be incorporated in the documents. So this is just a level of being detail-oriented and careful that will avoid us getting tripped up on audit when the IRS asks to look for all those records.
So going to the next slide. So we've been talking about the IRS because that's where Ginny and I play the most in our sandbox. But of course, as you know, there are other regulatory bodies that take an interest in what the family office does. The first headliner is the SEC. So as we probably all are familiar with, family offices enjoy an exemption from having to register as a investment advisor under the 1940 Act if it can satisfy the family office rule. And so here, in terms of protecting yourselves and being ready if the SEC were to come and ask questions, you want to be sure who is a family client. And to stay on the right side of that rule, we can only provide investment advice for compensation to family clients. And that's a broad definition within the scope of a family, because you can select the person who will be the reference point and then go down 7 or 10 generations. So in that regard, it's a nice umbrella. And key employees, that is, key C-suite type employees who aren't family members, are covered. But where this can get a little muddy is if there's co-invests, where the Smith family and the Johnson family decide to go and co-invest together. And while they may be very trusted with each other, they're not technically within the same family group. And so having an understanding as you go into these investments, what are the rules here? If we are providing investment advice, let's be clear that we're only providing investment advice. If we're the Smith family office, we're only providing investment advice to the Smith family. And if the Smith family is in a co-invest vehicle with other families, let's stop, pause, and just make sure that we structure it in a way that protects the family office exemption. Next one is, the normal employer type of rules that you want to be mindful of: equal opportunity, Americans with disability. More and more family offices are being asked to help handle health insurance or health information for family members. So we want to be mindful of our obligations under the Patient Protection and Affordable Care Act. What obligations do we have if we're handling confidential health care information for our family members, making sure we're mindful of those. And then the local and state business laws and regulations. Family offices that are engaged in a trade or business need to qualify with the state to which they are providing their business. And so we want to just make sure that whatever state and local requirements our businesses have, we're being mindful of it and complying with those regulations. And I think we might have a poll question here, if I remember right. So, the question here is, have you participated in an SEC audit on the family office exemption? And if so, how long did it last? And similar to the IRS one: no, less than 6 months, 6 to 12 months, yes, over a year. I'm curious on the group's experience with SEC activity in this area.
That's also consistent with what Tom and I expected.
Yeah, exactly. You know, this is an area that for those who have worked with us, you probably heard us beat a drum on this because I do think it's an important, but this is a nice empirical data point. So thank you for sharing. Okay.
All right, and we're on to the proactive analysis section. And I thought it would make sense to describe a little bit about how this came to be and why I think it's important and why it's something that family offices should do once in a while. I spent decades litigating tax cases for private clients and getting frustrated by the impact and ramifications of missteps that happen before audit or during audit. Some of those not really following the internal controls and procedures that we've just been talking about. And then additionally, things that happened during audit. And I started thinking about, well, why is this happening? And how can I prevent that from impacting the results that I can get from my clients later in litigation? And I realized that most of those missteps were because people were being forced into a reactive position. They get an audit notice and they think, okay, how do I satisfy the auditor and get them off my back? And they just shift into producing in a very reactive way. And the best way to handle an audit is to be able to do it very proactively and understand where the weaknesses are and the amount of exposure that is related to each of those weaknesses, and then be able to navigate the audit with full information about what the auditor might be asking for, when you've got a really good deal on the table, when you might want to concede an issue early. And we can get much better results for our clients in audit if we kind of know the full picture and know what the risks are. So this is a process that I developed to help family offices understand their tax exposure and their tax risks, and then take active steps to fix it. So there are lots of things we can do in advance before an audit starts that we can't really do once the audit is underway. And so if we can identify what the problems are and potential solutions for them ahead of time, we can prevent those risks from occurring. So step one is define the priorities and process. And I had a little time on my hands, so I did these all in acronyms. So we've got discuss concerns, priorities, and goals. And this is an important one because it can be different in every situation. We want this process to be strategic and well-defined from the beginning. This isn't a run amok, let's go through all of the records of the family office and dream up what the problems could be and spin our wheels for the next 3 years getting creative. This is, here's the goal of the office and the family members. Here's the level of comfort that they want. These are the concerns people have voiced. These are the priorities. This is how risk averse or not this particular family is about their tax issues, their publicity, whatever their pressure points may be. And we work on a process that actually takes all of that into account. And then once we refine those priorities and goals, it makes sense to talk to advisors and employees who may have more information than the people who have originally set those priorities and goals, so that we can understand what we're gathering, and they may know something that we don't, and that the person who hired us doesn't, and it helps us to get their input. And then we go through a process of thinking about what documents do we need to collect and how should we be managing those documents for the future. So, the most recent example I can come up with for you on this situation is, when I get hired at the beginning of the estate tax return preparation process. Patriarch recently died. And we have to think about, okay, we're very, very likely to have an audit here. So it is most efficient in this situation to start that collection process, create the PDFs, create the database, and have these documents that we're going to need ready to produce and organized and tagged and flagged. And then that way I look at them once during this process and not again 9 months later when the audit starts. If an audit is much more of a tentative, maybe it'll happen someday kind of situation, we may implement a very different process for collecting and managing the documents. It depends on the specific situation. And then a key one, and we'll take a poll on this issue, is instructing the family and team members about how to protect privileges. So in this poll, I've asked you to rate on a scale of 1 to 5 how carefully you protect the attorney-client privilege, the tax practitioner privilege, and the attorney work product doctrine. And there are descriptions here about, down at 1 is protecting privileges is not part of your role, and that's perfectly understandable if that's the case. All the way up to 5, where you've really got this nailed, and you make sure that you're instructing other people about how to do it the right way. And we'll see those results when they come up. There we go. So a lot of people in the middle zones, 22% have it nailed, and that's fantastic. But a larger percentage are in the middle. They understand the privileges, but maybe aren't taking quite as many steps as we could be to make sure that privileges are protected in the family office context. And this is something that we work on regularly because family members sometimes need to understand who can be in meetings and calls, who really can't unless we take some other steps to document a privileged relationship with that circle of advisors. And concepts about how documents are stored, the fact that they shouldn't receive an email from their attorney and then pass it on to 4 of their other friends or people outside the circle of privilege. And really working with anybody who might come into contact with privileged information to understand how important it is to protect the confidentiality of that information. One other tip on privileges before I move on is that if you're hoping to assert the attorney work product doctrine, you should be realizing that to assert that, you're saying, hey, I anticipate litigation. That's what triggers the attorney work product doctrine, is an anticipation of litigation. So back to the document retention policies that we've talked about. Once you anticipate litigation, you have to put any document retention policies that allow for destruction on hold and issue a hold memo saying, hey, I anticipate litigation on these issues, so we cannot destroy any documents related to this issue because we believe that we might have to litigate it. So those things go hand in hand, and you don't get the protection without taking on the obligation and the responsibility. And people forget that very often. So just to highlight that for you. And the rest of this is more about timelines and making periodic and final reporting. In certain situations, you're under a timeline and a deadline. If a 706 has to get filed and you really want to do a thorough analysis of all of the issues and exposure before that 706 gets filed, you can back up from a deadline. Other times there are other reasons why the family office needs this to happen at a particular point in time. And so that's just about working out those issues. We can go to the next slide. The next one is to shape the inquiry. And this is kind of step 2 of what is this process going to look like? Because it's iterative. So often y'all start looking at one issue, and then in the process of looking at that issue, realize that there are 3 others that are really much higher dollar amounts or much higher risk for some other reason because of information that would be disclosed or some other problem. And so this is part of the preliminary spot issues and prioritize them. And then think about what's the most efficient plan for getting to the bottom of those facts. Who should we be interviewing? Where are the key documents stored? And then at some point early on, figure out what is the potential exposure. Because if the potential exposure is $10,000, nobody wants to pay me $100,000 to figure it out or solve the problem. So it makes a lot more sense to very early on say, you know what, from what I can tell about this issue, it's about a $50 million issue, and it's worth it to you to have me do pretty much whatever it takes to fix it and help avoid that. So that's part of those early conversations as well. And we put together an investigative plan and a budget and talk through the people the stakeholders about their priorities and make sure that this is how they'd like to allocate their resources in what we're working on. The next slide. Step 3 is to master the facts, and this is a big part of the whole overall process, because this is where we really go in and get the documents, analyze the facts, interview the witnesses. And one that I find very important is thinking about what information might exist that's outside the family's control, and how do we get it and how do we preserve it? Because the earlier we do this, the better. Time is not your friend in terms of having to prove support for a tax position, especially when it's in an estate context where sometimes you need to prove that there was an unrelated party in the form of a corporate fiduciary who actually had full information about a transaction a trust undertook. Well, if that corporate fiduciary has gone out of business or merged 3 times since then, you're going to have a really hard time potentially tracking down the documents that show what information they had, what approval process they went through, how they participated in that decision. And the sooner you get to them and get that information gathered and within your control, the better you are. Also, enlisting expert assistance. Typically, the expert assistance we'll need at some point is an appraisal, because a transaction inevitably has happened where a timely appraisal didn't occur. and to really quantify what the tax risk and the exposure is, we need to know the value. That's my most common need for experts as I go through this. And then recognizing when additional investigation is valuable and when it may be counterproductive. Most of the time it is valuable. There are other times where you really want to put a stop to it. So if I've uncovered something that I think is actually very damaging, and I know enough facts to know that it's damaging, the last thing I want to do is gather more evidence of how bad it is and talk to more witnesses and refresh their recollection about these bad facts, so that when the IRS knocks on the door 2 years later, suddenly they remember something that happened 15 years ago because I've been drilling them about it now, and they might have forgotten it otherwise. So this is the part of the process that is really much more art than science, because it's thinking through, how does this play out at a trial down the road? And how does this play out over the next few years? And how do people respond to questions in interviews and when the IRS shows up at their door and wants to talk to them? The next slide, please. Step 4 is assessing the risk and mitigation techniques. So this is where all the facts come together, all the law comes together, and then you look at what's the exposure and you quantify that exposure, and then evaluate the pros and cons of all the different proactive ways to mitigate it. So sometimes you might want to file an amended return. Other times you might not want to file an amended return, but be ready to concede part of the issue very early in the audit to put a stop to questions that blow open a much bigger issue. Sometimes you need to go in and file missing information returns so that you start the statute of limitations running, or missing gift tax returns so that you start the statute of limitations running. It gets especially complicated if you're dealing with other third-party taxpayers. So if you have a family member who's been paying cash bonuses or paying household employees in cash. Depending on the level of those cash payments going out the door, you suddenly have problems not only for their reporting and employment tax obligations, but for those of the employees who were not reporting all of their income. So there's a whole process to thinking about what can we do, what should we do, what hurts more than it helps, what sets us up for success at the end. Next slide. And then this is the last part where we sit down with the stakeholders, with the office and the family members, and explain what all the options are, what can happen, assist in implementing that, and then the most important part from my point of view are the last two, which is now if an audit notice comes in, we are all ready to defend that audit. And we know where the soft spots are, we know how to navigate, we have all the issues. It's no longer a huge burden on anybody because all of the information is already gathered and ready to go. And we can make sure that any new planning is done with sensitivity to those existing soft spots. So instead of exacerbating a problem, we can fix it and make sure that we fix it either through transactional planning or for how we report something going forward. So that is the end of our discussion on the proactive analysis. And we're getting close to time. If we had questions, we could take them, or we can go to our hot topics.
There are no questions right now. Why don't you cover some hot topics, if you would, Jenny?
Okay. So the first is private foundations, and Tom talked a little bit about this before. For anybody who hasn't heard this yet, IRS is making a huge audit push on private foundations. They've been announcing it since about June. Tammy Ripperda is now the commissioner who's the head of TEGE, and she used to be the head of the Global High Wealth Audit Group. And so she has decided that keeping those two groups siloed doesn't make any sense, and they want to have much more cooperation between the two. So TEGE has trained about 400 Global High Wealth examiners on private foundation issues. And they'll be assigning people from the EO team over to Global High Wealth audit teams. And they've been doing significant data mining, looking for what they're calling linkages between the private foundations and other entities within the, as the IRS puts it, enterprise controlled by the family. And they're going to use those linkages to identify potential audit leads and initiate audits. So over the course of the next 6 to 9 months, I think we will all be seeing quite a lot of activity in the private foundation audit space. Tom, do you have something you want to hit on this list before we finish up?
Yeah, the two that I would just draw our attention to, I oftentimes get asked about the trader business point and what I'm seeing happening there. In that regard, I am not aware of any additional filed cases in the vein of lender management. So I think that still stands as the most recent enunciation of the considerations. I think everybody's familiar with the Hellman case that didn't get out of summary oral arguments for summary judgment, but I have not heard of, doesn't mean it's not out there, but I have not heard of another filed case going along those lines. And then on executive comp, I would just note for those, again, who use profits interest in whatever form they use it, I would note that the IRS just issued some proposed regulations under Code Section 1061, which is the code provision that deals with the character. This was how the IRS and Congress focused on the taxation of the carry. So, it was, I think there were like 100 plus pages, so light reading, but at least it's, with the profits interest, there's not a whole lot out there. And so anytime the IRS speaks on the subject, it's always interesting to see, usually the preamble sort of trying to get insights on how they're thinking. So again, we'll see how that, again, these are only proposed, but we'll see what happens with those. But those are the two I wanted to highlight, Jenny.
Great. Let's do our last one, which is cryptocurrency, and I think we have a poll question on that, which is just whether you or taxpayers you advise own cryptocurrency. This is a hot topic for IRS. They're doing a lot of thinking about how to effectively audit cryptocurrency holdings and whether people are reporting them correctly. So I also expect to see even more activity in that arena coming up in the near future. I am not seeing results from that poll, and I can't personally vote. Ah, there we go. So 25% yes, 75% no. I thank you all very much for your time, and I'll hand it off to Tim to close us down.
Thank you, Jenny. So thanks everybody for joining today's Private Client Virtual Forum, and thanks Jenny and Tom for a great presentation. Upon leaving our program, you'll automatically be directed to our event evaluation. We value your feedback and appreciate your comments so that we can continue improving our programming. For those requesting CLE credit in New York, please enter the code PURPLE16, capital P, lowercase URPLE 16 in the event evaluation forum. Thanks very much.